As a tax administrator, I have no choice. If the case is before me, I need to. Mr. Vispi Patel has raised some issues. I need to respond. I will respond.
Thank you, sir. Thank you, sir.
Among the issues, um, he would like a debate. I don't want to impose a debate on all of you. So let me deal with it in my own way. I'll take you through another example which will help you in your understanding of TP. The penalty provision relatable to TP. That will illustrate what I'm saying. There is an explanation 7 to 271(1)(c) which deals with transfer pricing adjustment. What does this explanation say? If there is an adjustment that is presumed to be a concealment of income, it is deemed to be concealment. The quantum of the adjustment is the quantum of concealment. Now, you just look at it, you have a huge amount of jurisprudence based on mens rea, whether a practitioner's opinion can lead to a penalty in the hands of the assessee, whether mens rea intention was there or not, whether a bona fide claim will save you from penalty. There's so many such things which have developed over time. But when you have the law which says TP adjustment will be deemed to be concealment, matter ends. Mr. Vispi Patel is an academician. He prefers to enter a subject from its origins and background. I'm a tax administrator. My first view is, what is the provision? What does the provision say? That is the starting point. If the provision is clear, I don't have to go anywhere else to discover its meaning. If some term used there is capable of more than one meaning, I need to go to some case laws, to some things, to determine that. Here, and just to take you further on that penalty aspect, there's a footnote. Unless the TP study report, what you all have prepared on behalf of the SST, and that's where your role comes in. If the TP study report has been prepared in good faith and with due diligence, then the first part of the deeming provision will not apply. It will not be deemed as concealment. Now, one, you have a huge responsibility to be able to establish in a penal proceedings that you have prepared it in good faith and with due diligence. The other aspect, now these are terms which have a very subjective determination. What is good faith? What is due diligence? Your opinion, my opinion, someone else's opinion may be all different. That's where law creates its litigation. We'll deal with it when it happens. This was with reference to the third question which Mr. Vispi Patel asked me, that if an explanation, can it differ from what the section means? 271(1)(c), the main section, says something. Explanation 1 adds a dimension to it, which is used under what we call regular provisions of the Act. Explanation 7 deals with transfer pricing. If explanation 7 deals with transfer pricing, then the judicial principle that a specific provision will overrule a general provision comes into play. If explanation 7 deals with TP, for TP matters, explanation 7 will apply. not the general provisions. Coming to the second question, that order I may have forgotten, the locational advantages. The issue is, so Patel mentioned that look at comparables. I had taken up the example of clinical trials. Profit earned by the company I'm looking into. This is what assessee is saying, this is what tax practitioners are saying. Compare him with other people in the same field, other people who conduct clinical trials. And if the profit margins are comparable, we treat it as being at arm's length. The department's problem there, and I would try and explain it to you, what we are looking at and how we are looking at it. All these are, a term I used earlier, tainted comparables. All of them are being exploited by the white man. There may be 10 different people supervising clinical trials in India. All of them are being underpaid by the US, German, Swiss main principal entity. Is it a fair comparison? We come to, is it the proper method? Should we be using CUP for this? No. In our opinion, we should be using PSM, profit split method, wherein the savings on account of location are to be shared between the two entities. Whether it's 50-50 or we have a more refined sharing ratio is something to be worked out. Comparing a assessee, an entity, let's say in the field of clinical trial, with other domestic comparables is not a fair comparison to determine the locational advantages. All of them share that. Therefore, to determine that aspect itself, it's not a good example to take. If you want to see whether a person with one damaged leg can run how fast as compared to, or what discount should be given as compared to a normal person, you have to compare him to a normal person. If you compare him to another person whose leg is also damaged, that won't give you the correct result. Therefore, locational advantages have to be seen in domestic versus overseas scenario. And in that, domestic comparables are not the correct method to establish the arm's length price. The last issue which he mentioned, or no, I forget, if you could refresh me.
That was for the issue of shares.
Issue of shares, yes, sorry. So Patel mentioned, what if a scenario we were looking, or we were talking in that Shell case, of an example where share worth 100 rupees is sold for 60. Therefore, the foreign entity has got advantage of 40 rupees. All right. What if the reverse is there? 100 rupee share is sold for 150. Has the Indian party been disadvantaged? That's what Patel asked. No, I say the Indian party has been given unfair or undeserved advantage. It parted with a share having a value of 100. In return, it got 150. So it has got an unfair, undeserved advantage. Now the issue, should TP look into it? Transfer pricing. It's not a new issue. We are facing it all the time. In TP, you'll realize this issue. I had not mentioned it earlier. Your transaction price is, let's say, at 14% profit rate. The comparables are at 20%. So you say you have earned 6% less than the comparables. So 6% profit will be added to your net income by way of adjustment. That is a normal scenario. What if you have a scenario where 14% is your margin and the comparables are 10%? Do you say, give me now, reduce my income by 4%? The law anticipated this, that TP is for enhancing the income. You can't claim it as a basis for a discount. And it's not new in law. We had this controversy with reopening Section 148 earlier. And courts clarified, 148, Section 148 reopening is for the benefit of the department, for taxing escaped income. That cannot be the occasion for the assessee to raise fresh grounds of discount or relief. Courts recognize that. So can transfer pricing be used to reduce your income? No. Your income is what your profit and loss account says. Government reserves the right to enhance it if it is of the opinion that income which should have been earned in India, which should have been shown as earned in India and should have been taxed in India, has been shifted overseas. In that scenario, the government reserves the right through the transfer pricing law to enhance the income returned by way of transfer pricing adjustment. It cannot be a ground for a discount, and law has incorporated that under 92C3. 92.3.
Correct.
Law has incorporated it that transfer pricing or difference with reference to the arm's length price cannot be used as to support a claim for a discount. Your income cannot be reduced through transfer pricing.
Thank you, sir, for your valuable views. Of course, we will have more opportunity to discuss this issue over and over again till the last panel session. So, till that, the finger be crossed, and we'll get the right answers in the due course, I believe. With this remarks, may I request Naresh Ajwani to propose a very well-deserved vote of thanks for Vaishali Patel.
Friends, Mr. Vaishali Patel mentioned that he has limited understanding. However, you have all, I think, realized that he has only shared his limited knowledge of vast understanding, and more of it we will see on the last day of the last session, where we'll have a panel discussion where we will see his high level knowledge coming out. He has laid down the theoretical base for this entire TP course, and I'm sure all the points which he's mentioned, which will be elaborated in the next session, will be very useful. I think Mr. Singh also deserves a vote of thanks for the second time for responding to the queries ex tempore, and both of the speakers have discussed this in the opening session so well that though we are running late, I'm sure no one has really felt that okay, it's late. I mean, we are all enjoying it. So again, I request all of you to carry this vote of thanks with a very loud applause. Yeah. Friends, we'll just have a short 5 minutes break before we move on to the second technical session of this course.
A very interesting session in the morning. We now have, as a process of the transfer pricing,
of FAR analysis. And we have with us Vaishali, Vaishali, who will be telling us about the FAR analysis and comparability of principles. And to formally introduce, I would request Namrata to come forward and introduce the speaker.
It's a pleasure to have Ms. Vaishali here this afternoon to introduce to us to one of the fundamentals of transfer pricing, which is functional analysis and comparability analysis. She's a director of transfer pricing at Grant Thornton and has a 13 years of work experience behind her, despite the fact that her face doesn't show those 13 years. She has advised a large number of multinational and Indian companies in structuring, planning intercompany transfer prices, as also in the assessments and compliances. She actively conducts transfer pricing courses and trainings for member firms within the Grant Thornton network. Not only that, but she's a regular faculty at the transfer pricing course at Chambers also. And she has written numerous articles and papers for various magazines such as the BNA, International Tax Review, Tax Analyst, etc. With this short introduction, I would like you to welcome her with a warm applause. I would request President to hand over a memento to her as a token of our affection. And without much ado, I would request Ms. Vaishali to take over and let her speak for herself.
Thanks a lot, Namrata, for the kind introduction, and to CITC for inviting me for the fourth time to speak on functional and comparability analysis. Now, as you have heard what Namrata said, that functional analysis is the core in any transfer pricing exercise that you do. So what do we mean by functional analysis and why is it so critical? So functional analysis is nothing but explaining to your tax officer as to what your business is, what your international transactions are, and in that international transactions, what is the role which has been played by each entity, because it is based on what functions you undertake, what assets have been employed, what risk you have taken, that you're going to get the rewards. So though you feel that transfer pricing documentation is just a compliance, actually in a real life scenario, when we come across so many multinationals, it's just not a compliance. It's just not like filing a form 3CB and forgetting it. Transfer pricing is a very important tool because increasingly you see that businesses are facing so many challenges. So it enables a business group to decide as to which entity is doing what in the entire group, because each tax authority, as you know, transfer pricing rules are prevalent all across the world. So each tax authority wants to protect their tax base. So whether you can leave a cost plus 30% in India, considering the way the economic scenario is globally, the tax authorities want to know which entity is doing what within the group. And it also helps the group to plan their activities well in advance as to which entity will take what role, how much profits are there in the entire supply chain, whether there are profits, which entity is going to take the losses, and which entity can control the entire supply chain. So with that in our mind, we'll try to understand what functional analysis is. So in this analysis, we try to understand the three core components. What are the functions of the various entities in the transaction, what assets they have employed, and what is the risk that they have undertaken. And in any transfer pricing study report, you will see that these are the core components of that study. Now, why do we undertake a functional exercise? Because even we as a consultant or maybe a tax officer may not know each and every business. Like there are some businesses like software, back office processing, which may be simple, which probably all people are aware of. But there are so many businesses, especially the manufacturing setup, where the products that are being produced are so niche that it is necessary to understand what is it that each entity is doing, because that helps you to determine what comparables you are going to choose and how the industry is, whether that industry is facing any specific challenges. Functional analysis also helps you to characterize the entities. Like you must have heard about tested party, people talking about tested party. So tested party is the entity from whose perspective you are going to look at the transactions. So typically when you do an Indian exercise, you will see that the transfer pricing officers only prefer Indian comparables. That is because they are more concerned about the Indian tax base. They are more concerned about how much profits are being offered for taxes in India. So they look at it from an Indian perspective. So you, from India, what is your role and whether you are the tested party and what are the comparables. But if you see transfer pricing globally, it's not necessary that India can always be the tested party. It may happen, for example, we'll take like a software company which is a parent in India, and this parent has developed the software product, which is say a banking software product. Now it may have taken 2-3 years time to build this product. There are huge costs. These costs may have been amortized or they may have been capitalized. Now they have set up their business plan that okay, my product is going to be very popular in Middle East, in US. So they may initially start with some third-party distributors. As the time passes, they may feel instead of operating through channel partners, let us have our own subsidiaries overseas. So they may set up their own subsidiaries. Now it may happen that in the initial years of operation, these subsidiaries may just be marketing entities, which means they just try to make the India entity known locally, what are the products, they just 1-2 years spend marketing. And after that, when the awareness is created, the product has gathered momentum in those locations, it may happen that the model is changed and India may license these products to those local entities and the local entities then distribute. So in this example, what we have seen is 2 scenarios. So it's not necessary that a business remains static. Like if your entity overseas is a marketing entity, throughout its life it's going to remain marketing. The way we see is it starts as a marketing entity, 2-3 years down the line it progresses and becomes a distributor. And if it's a product, maybe as the markets become more and more mature, you may also want a manufacturing setup. So even that entity may become manufacturer. So today, when that entity is a marketing entity and India is a parent which is developing all those software products, we see that India is a much complicated entity, while the overseas is much simpler. And being an Indian group, they may want to leave behind maybe lesser margins which are at arm's length in the overseas jurisdiction, and they may want all profits in India because that helps them to plow back those profits in business, develop new products. So in this scenario, your tested party will be the US entity. So you will try to see that in these kind of scenarios, if US is your tested party, what are similar entities? You may have companies who have other marketing entities in US, other independent entities in US, what is their returns? So you would want to leave behind a profit which is equivalent to those and accordingly devise your transfer pricing policy. So that is how we will correctly do it considering the transfer pricing principles. So it helps you in economic characterization. So in the example that we have seen, we have taken US, which is a lesser risk entity, which is a simpler entity as the tested party. So we have characterized in this transaction India as an entrepreneur which is developing these software products and the overseas entity as a marketing service provider. So we are able to do this because we have understood what the functions of these 2 entities are, and that's how understanding the functions and also what the objective of the group is helps you in characterizing those entities. So that is the objective of functional analysis. So as I mentioned, in functional analysis, we'll study the functions, the assets and the risk. So in our given example, the assets which have been invested are significantly with the Indian entity because they may have people, they may have offices, they may have spent years on doing that research. So they have that intangible of that software product which they may have registered in India. The risk, India has taken a considerable amount of risk. It has invested the money upfront. If the product is unsuccessful, then the risk is on India. So we have to understand the functions, assets and risk of the transactions. So any questions so far? So how do we do a functional analysis? Now first, you need to identify what the international transaction is, or maybe what your SDT is. With that, you will be able to know which people you have to interview and what are the questions you have to ask. So in the example that we saw, the transaction, international transaction, may be payment of marketing fees to the overseas entity. Or there may be also a model where the overseas collects the revenues from the clients, retains its marketing fee, and gives back the balance amount to India. So these could be either marketing services or marketing services plus remittance of the revenue. So once we know these transactions, we have to identify whom we are going to interview. So in the Indian scenario, you will want to interview the finance head to understand this transaction in detail. He may explain you or provide you the necessary contracts, the terms of the contracts, etc. In addition, we would also want to interview the product person who knows what the product is, specifics of those products. Whether in this scenario, whether there's a marketing head and a sales head sitting in India to whom the overseas marketing person is reporting to, that is another question we would want to know. So we'll want to even interview the marketing person. From the US front, and you should always ensure that your functional analysis is not lopsided, because what happens is at times, especially not in Indian MNCs but in the foreign MNCs, if you only interview the India people, we have seen that you get a lot of, your functional analysis could be lopsided, where you understand what the functions of the Indian entity are, but you may not completely understand what the overseas functions are. So a functional analysis is complete only when you hear both the sides and then decide, take a fair view of who is doing what. So in this scenario, you would also, I think you need to put the charger. Yeah. So in this scenario, you would also want to understand from the US side what the marketing, interview the marketing person, which you can always do through conference calls, etc. So you have identified people whom you are going to interview. Then once you have identified whom you are going to interview, what are the questions that you are going to ask them. So when you are going to interview a product person, you can always try to understand what this product is. From him, you will get an idea of what the industry is. Then how are the contracts structured, like whether with the final customer you have a lump sum contract or it is going to be based on per hour basis. If you have lump sum contracts, it may happen that you have some amount of losses. So it may happen that the marketing entity you have given cost plus, but in India you have so many costs that you may have a loss scenario in India. So what are the reasons for those losses? So that you will come to know from the finance team, from the products team. And documenting these losses, though you may take US comparables and US tested party, the transfer pricing officer would always want to know why there are losses in India, and you have to be prepared with those kind of questions. So you have to interview the product person from these all aspects. Similarly, the marketing person, as you have heard increasingly, apart from product, even marketing has become a very important intangible. It may happen that when you set up the US distributor who takes the product on license and further distributes, there are so much revenues being generated in US. It may happen that the US IRS may say that so much of marketing efforts are happening in US and there's a marketing intangible there also. So you have to be aware, because in transfer pricing, intangibles play a very critical role. You may feel people is just, these are just people, but from a US perspective, a marketing person may be a marketing intangible that you have created. So you have to also interview and find out whether in this marketing scenario, whether the marketing head in India, whether he has framed the strategies in US, to what extent he controls the US market, whether he's governing that US team, how many people are there in India and how many people are there in the US. So these are some of the questions that you will have to ask to understand what is the importance of the marketing that is being done in India, whether US benefits out of it, all those things. Similarly, try to interview the US person to understand their perspective, whether they just do some normal attending of seminars, etc. There are, they have started a lot of efforts to identify the channel partners, dealers. They are undertaking excessive marketing efforts. You have to know those. So this was a simple example of US service provider and an Indian parent. So a functional analysis helps you, as I said, to understand the business, to interview the right people, to economically characterize the entity, and also to determine your method. So in this scenario where US is your tested party, what is the method that you are going to take? Like I said that you had some third party marketing service provider before this subsidiary was set up. So whether that agreement, which is quite new, and you have converted now that into a subsidiary, so it is within a 2-year period. So whether that can be used, mechanism can be used as an internal comparable rate, because if you are paying commission to him, whether you want to continue with that commission model. So in a commission model, what would happen is US, if they start selling the product and they get a commission, whether the costs are so high, whether that commission covers those costs, and whether there's a loss. So in the commission model, US also undertakes market risk, and whether you want US to undertake that market risk or you just want him to be a service provider. So in this scenario, though you may have a cup, you may want to change the model. You may want the US entity to be a cost plus entity. So the functional aspects of the US entity are very much different from the third party marketing service provider. So here the cup may not be appropriate, so whether you're going to use a TNM method. So the functional analysis and also the business plans help you to know the tested party, what is the method, and what are the comparables that you're going to choose. So what all goes into a functional analysis? The functions, assets, risk are the key components. Before that, you have to know what the transaction, international transaction is. Also, always try to get the agreement, because whatever are the functions that you have interviewed the people, that also has to be reflected in the agreement. Sometimes the agreements are so drafted that it may also create a permanent establishment risk for Indian entities. So whether that risk is there, because increasingly a lot of weightage is given, especially in litigation, to the agreements. So whether your in substance and your agreements are matched is very important, and you have to also analyze these agreements to ensure that unnecessary exposures are avoided in the transfer pricing agreement. And increasingly you need to have these transfer pricing agreements, because you will see that the officers want them. Then the financial results. Of course, when you are analyzing two entities, you need to have those financial outcome of both of them. Organization or staff, this also has become increasingly important, especially where two entities are involved, and maybe you're doing profit split, or maybe you're getting into an advanced pricing agreement, MAP. In all these situations, people, and as people are becoming more important, they want to know what are the kind of people you have employed, what are the kind of qualifications they have, whether they are low end, whether they are high end, etc. Forecast business plans, that's extremely helpful, especially in a loss scenario. So in our example, we saw that the Indian entity was in a loss. So the Indian transfer pricing officers will not easily accept the overseas comparables, the overseas tested party. We have seen so many situations where they disregard the simpler entity. Though the Indian entity is an entrepreneur, they still want Indian comparables. They'll still look for comparables from the Indian scenario and make huge adjustments of 20-25%. But all these matters are before tribunal. So in the tribunal, the functional aspects become very important. The tested party becomes important. And why is it that the Indian entity is incurring losses? So we have the decision of EKL, which was a Delhi Tribunal High Court judgment, where clearly the tribunal has given a lot of emphasis to business and commercial expediency. So whether, because a transfer pricing officer can never dictate to you, or the tax authorities can never dictate to you how business has to be carried out. Like for example, we have seen situations where there are certain customers who want to import some components. They may have some benefits of excise duty, some credits they may be getting, because of which they may prefer to buy the products directly from the overseas entity. Similarly, the group may prefer that because in that situation they get an LC, so money is received upfront, they don't have any credit period. So there is so much of business rationale behind, deciding how a transaction should be. So in this situation where the group feels that, say, the customer should buy directly from overseas and India should get commission, whether an officer can come back to you and say, no, you have this commission is just say 5% or 6% and it is not adequate, and there's so much of gross margin. Had it been a distribution transaction where you're buying and selling, so much of you may have got a gross margin of 40%. Against that you have a commission of 5%, so you're shifting profits out of the country. So it's never like that it's never, a decision is never taken maybe from a GP perspective, commission perspective. It's a matter of what your customers want. It's a matter of how you want to structure your business. So all these things that have to be documented correctly, that the customers want to purchase the products directly from overseas. If you buy and sell, maybe there is some VAT or some other implications. What are those rates? Vis-a-vis how much amount of business you're going to lose, because it may happen that the customer may clearly instruct that if this is your pricing, I'll go to the competitor. So because of the fact that the products can be directly sold, maybe you have an edge over competition. So all this data becomes part of your documentation processes, because these are the kind of questions that the transfer pricing officers ask. So it's just not about benchmarking. It's just not about saying that, okay, I'm going to give him a commission of say 5% and this is what comparables are, and I am arm's length. Increasingly, we have seen that the transfer pricing officers are going beyond all this and trying to challenge even the way you're transacting business. So this is where, all these decisions of EKL and other decisions that the tax authorities cannot dictate to you, the way business has to be transacted, become very important. So that's where knowing the business dynamics helps you in preparing for the litigation. And forecast and business plans will help you in that line, that okay, these are your forecast. Though you are in a loss scenario, when is it that you're going to break even? And maybe when the assessment comes up, by that time you may have 2-3 years data. So by that time you'll come to know that you are already in a profit scenario. So here I'll be taking one case study towards the end, where in the litigation scenario, the business and forecast played a key role in getting a very good favorable order. So increasingly all these things are given a lot of weightage to. Understanding the business processes, knowing what the industry or the market is, and how competition operates. So in this scenario, we saw that products were directly being supplied to the customers, whether your competition, and your marketing team will always know that, whether the competition is also operating in a similar fashion. So that kind of data where he's challenging your business model, that there the competition and how they operate is going to be very crucial. Understanding the products, like your product, I gave you an example where your product was very niche. So we have seen a live scenario where a company has devised a product which is used for coating, and it is a nano thin coating which they claim is the sophisticated technology which has not been developed by anyone. So if this is what they are going to claim, in the first place we will have to justify that their claim is correct, verify whether it is correct, and what kind of comparables you are going to have, whether, because in this kind of a scenario you will have to take so much of marketing efforts to prove all these things to your customers. It may take time to for your product to be established in the market. So that is where the business plans and interviews with the marketing team are going to help you a lot. Whether your comparables are the right comparables, because they may just take some chemical, like you are a distributor of these chemicals, a transfer, and you are incurring losses. So a transfer pricing, what typically officer he'll do is he'll just find out some general chemical industry, he'll find out some distributors, and distribution the database is so limited that at times you don't even get chemical distributors. He may take all distributors, pharmaceutical, cosmetic, whatever distributors, and he may try to benchmark you. So in those scenarios where you don't have proper comparables, how do you explain to him that your transaction is at arm's length? Explaining him the product. So maybe you can take your product person and let him understand what this product is about. So that is where having an in-depth analysis of the business helps you a lot. And also the entities. So which are the entities that you're doing business with, and what is the role that those entities play? So these are the components which you should know before conducting a functional analysis. So any questions so far, or any thoughts? The data of comparables you mean. So there we have databases like Provest Capital Line, which are databases which are accepted by Indian tax authorities. So each country, now transfer pricing has become mature, so each country has their own database. Similarly for royalty, for these marketing agreements, you have databases which are global databases. But in royalty, they have started relying on all these databases like Royalty Source and all those. So we had couple of litigation cases where Indian entities were paying royalty. So in those scenarios, though we have the royalty rates and all, which were once upon a time laid down by RBI, and we have ITAT judgments which say that okay, if those are there, it is arm's length. But the transfer pricing officer also wants to know what are the royalty rates prevailing in your industry. So there, they, at least in Mumbai, they rely on Royalty Source. So that agreements they definitely accept. And they also want to understand what are the benefits, especially in royalty, in marketing agreements, in management agreements. They want to also understand the benefits. So databases more or less is available. So at times you have dearth of data. So there you have to use all these other documents to support your case. Tested party.
But if you see Indian regulation, Indian Income Tax Act, there is a decision of Onward Technologies Limited where tribunal has literally interpreted the law and said that in India, if you see the transaction like Majima, it says that profit realized by an enterprise needs to be compared. So it is clearly the Indian enterprise needs to be tested, and it can never happen that you can test the foreign enterprise. So what are your thoughts? Whether that decision is error in interpretation, or because if we go ahead only Indian
Yeah. So after the Onward Technologies decision, there was also another decision of the Ahmedabad tribunal, which was in fact reverse of Onward, where they said you can use overseas tested party as comparables. Now, what are my thoughts on using overseas or Indian comparables? Now, you have to understand that the way transfer pricing assessments happen in India, it's not necessary that they are happening purely from a transfer pricing or a perspective of considering the transfer pricing principles. You also have to understand that the transfer pricing officer is also in charge of ensuring that the tax base of the country is protected. And increasingly we have both kinds of officers, where officers understand the principles and they will appreciate the reason for losses. We came across so many officers like that. But there are, on the contrary, officers where we came across a situation where he clearly cited the Onward Technology decision and said, no, I cannot take overseas comparables. But there, whether he, because he clearly indicated that, okay, let me even understand your fact, because transfer pricing is a very fact-based exercise. So we had to sit with him, because they don't, some of them have accesses to overseas databases now. So he wants to go through that database. He wanted to see for himself how many comparables are there. And he went at length to understand what are the losses, for the reason for losses of the Indian entity. And in fact, in one of the scenario where he wanted to use Indian comparables, and my entity was an overseas tested party, and we had just paid them cost plus 8. He said, no, I'll use Indian comparables of marketing entities. So I said, you can use, because Indian comparables will be cost plus 15. So there he realized the mistake that in each and every scenario, in Indian comparables or Indian tested party is not going to work. But they try to, whenever India is into losses, they will try to harp on the fact that India should be the tested party and Indian comparables should be used. But here we have conflicting judgments, but I think you should not only use the foreign database or foreign comparables, but also try to ensure that your documentation is very strong. So you have to be upfront ready with some of the questions that the tribunal may ask you about what are the reason for losses in India. Like we had another case of a distributor. In a distributor scenario, the entity was in losses and they tried to use the RPM. But here the data was also given of the overseas entity, where it was shown that the overseas entity was just making 1 or 2% margin. And there the tribunal was convinced that, okay, in this scenario there are some extra efforts to set up the product in India for the product to be accepted, and they were comfortable with the fact that the overseas just had very little margins and there was no profit shifting. So it's not necessary that if a decision comes out, because there are so many conflicting decisions, each Mumbai tribunal says something, Hyderabad says something. So you have to be prepared with your case, and each case is fact intensive. Like in this case, the overseas had very less margins. In another case, the overseas may in fact have very high margins, and it may be the fact that they are shifting profits. But despite that, maybe you have some business plans for India 3-4 years down the line, when actually the assessment happens, India has turned around and there is a profit. So there was a situation where the officer said, okay, you are in losses for 2-3 years. We understand that there's a gestation phase of 3 years, but show me that there's a profit in 4th year. So whether those plans are there, whether the mid-year results are there, so all these things have gained a lot of weightage now. So coming to the outcome of a functional analysis, it helps you to identify your approach or the methodology that you're going to take in your business. What internal comparability whether you have, because internal comparables are the best comparables. But again, it depends on what model the overseas or the group wants. They may want a model where maybe they want to deviate from that and have some more risk or some more functions in the Indian entity. So based on the model, whether your internal comparables are the correct ones, or you're going to ignore those because they are not functionally comparable and have outside comparables, or whether you're going to have the external comparables. Functional analysis also helps you to identify the risk and opportunities. So many times when we do the functional analysis, we realize that things are not being correctly done. Maybe there are ways in which there is an opportunity of tax saving for the group if it is structured in a particular way. Sometimes we come across situations where there is a lot of permanent establishment risk, like maybe contracts are concluded, negotiated, everything is happening in India. So those kind of risk may be there. So when you are doing income tax returns, etc., you are least bothered about what his business is or understanding it. You just go and file the returns. So similarly, a transfer pricing exercise, if taken, in a correct way, will help you to know what are the nuances, because at times a consultant may study 3-4 companies within that industry. So he may be able to at times also add value to the transfer pricing exercise. So increasingly we have seen this happening, where companies want a planning done. If there are losses in India, they are spending money to identify what are the reason for losses in India, whether it's actually the transfer pricing which is wrong, or whether there are some reasons. So there we try to analyze the various Indian contracts, realize that at times India is inefficient, at times it's the policy which is wrong. So it helps you to identify the risk and opportunities. It helps you to identify the method, characterize entities, and document the entire process, because ultimately the objective is also going to be transfer pricing documentation. So after functions, the next critical thing is the assets, where intangibles is something that the Indian as well as the overseas officers are behind. So if they feel that there are certain, and increasingly even business restructurings, whether there's an intangible in India and whether you are transferring it out, whether the value that you have ascribed to that intangible, whether it is correctly valued. So these are the kind of questions that they have started asking. So what are the assets, whether you have, like if you're developing software, whether you are closely monitored by the US entity and you just follow their instructions, or it's a service, or whether you are creating some product also, like in safe harbors also they have defined a separate margin for service, separate margin for product. So functional analysis, especially talking to the product team, the IP team, helps you to understand whether these are just the routine intangibles or whether there's some intangible which is very high value adding intangible that is created. Coming to risk, now this is how a functional analysis looks. So in any supply chain, these are the functions assets you're going to have, and these are the risk. So a functional analysis typically in a service industry or a distribution setup is a little simpler as compared to a manufacturing setup. Similarly, within a company, you could have some amount of manufacturing, some amount of trading, and some amount of service. So whether you should do it activity-wise or whether you're going to do it entity-wise, those are some other questions you may face. Similarly, a transaction, as I said, of royalty or management fee, it's such a simple transaction that, okay, I'm paying royalty. Whether any functional analysis is required for this, no. An Indian company may feel that, okay, there are those erstwhile RBI percentages and I will put those in the TP report, and transaction may be just arm's length. We came across a situation where the officers in fact did a functional analysis of the royalty transaction, where they go to the extent of finding out how old is this IP, whether this IP is still there or it has become like an obsolete thing and there are new IPs that have come about. How much amount you had spent on this IP, whether you've recovered or you're still charging those 5% and those are now becoming your supernormal profits. What is the industry that you operate in? In India, whether anyone is using it overseas, if you're acquiring it from your IP provider, in that market, whether he's giving it to a third party, how much within that industry third party are paying, what are the benefits that you have received out of this IP. So these were the questions that they asked. So here, interestingly, there were many facets to this assessment. So and it's not necessary that everything has to be from a database. Like the database can be a very expensive exercise when you want to get royalty agreements, etc. And the transfer pricing officers understand that. So at times you can also do industry research. So in our case, we did a lot of industry research and we came across the fact that in this industry, we came to know about the competitors in US who were giving similar technology to third parties also. So we were able to get those snapshots, not the entire agreement, but it was the pricing was reproduced somewhere in a third party website. So we were able to get those kind of snapshots and give it to the officer. From the Indian perspective, we had some old data which showed that some of these companies who are competing in India were able to get this. In fact, to our surprise, we saw that the management of the Indian company didn't know much about what the use of this IP was, though his product or the marketing team know. But interestingly, the marketing team had put a lot of information on the website of this Indian company about where this technology was used. And in fact, they were the leaders in market because of the use of this technology. They had received many awards and all that information was put. So we were able to demonstrate this to the officer and he clearly accepted the fact that, okay, this technology is adding value to the Indian business. So it's not necessary that in any scenario just a benchmarking can be an answer. So we have seen that it is your business dynamics, your business facts that are very crucial. And with that data also, like in this example, without a benchmark, with all this evidence, we were able to substantiate that transaction. But again, it depends on officer to officer. It may happen that the officer is again hell-bent, along with this I want a benchmarking. So it clearly depends on that. So coming to functions, assets and risk, typically in a manufacturing setup, you will see all these functions. The manufacturing, who is developing that product, who is manufacturing it, the quality control. So at times, it may happen where we have seen very interesting things happening, where some businesses say that in India we have developed the quality standard. So the product may have been developed in US, like say example a software product. Ideally the quality standards also should be theirs, but it may happen that over the time, as India has worked on that product or implemented that product, they have come across certain quality tests and they have developed some quality standards which are slightly different from the overseas standard. So India may say, okay, this is an intangible which I have developed, so whether there should be some value attributed to this. So though a software segment industry looks very simple, increasingly, as you know, software also, it is so dynamic, where technologies keep on changing so often. So if you are transferring some IP, what is the life that you have used, whether it's going to be 10 years, whether it's eternity, or because in a software scenario the IP may have a life of just 4 years. So determining that life of the IP, all those things have become very critical. Valuation has become very critical. So more and more understanding that industry, the product, that technology, like we come across so many scenarios where increasingly because of the mobile technology, people want to advertise on the mobiles. So we have mobile advertisement companies. So what is the model that they want to have? You may have a company like eBay, which is selling products in India. So whether the model that was applicable to a distributor who used to physically take and stock goods may even apply to eBay, or there is something else that applies. So more and more businesses are becoming complicated, and the answer is understanding those businesses where all these things help you. Similarly, advertisement marketing, where I gave you an example where till now we thought that marketing or distribution was not that very significant. But increasingly countries like after the Glaxo decision in US, China, India, all of them feel that where sales are being generated, that is very critical. So in fact in China, I have heard from my counterparts that in their reports, no report is going to be accepted unless they have a locational saving adjustment and adjustment for a market premium. So market premium means that if there are some distributors in China, if an MNC has a subsidiary in China and they are distributing in China, the Chinese authority wants some extra premium for the mass of population that China has. So how do they carry out those adjustments, and whether locational savings still holds good is the other answer, because now we have seen increasingly the cost in India have increased so much. Salaries have increased, the value of rent, everything has increased. People are shutting down their back offices and shifting to Philippines. So whether locational savings still remains in India. So we haven't seen so much of locational savings issue in an Indian context, but of course in Chinese context we have seen it a lot, especially in APAC. So especially all these developing nations, there the transfer pricing is very, very rigorous. So all countries, in fact in Kenya we saw that their regulations are just a copy paste of the Indian regulations. They have also used the Indian terminologies. So many countries are looking at what India is doing, and they tend to have those kind of legislation in their context also. So risk, who is taking what risk? After assets risk, so whether India is taking market risk, like for example, you suddenly today the currency is at 62, but let us assume that the currency starts, the Indian rupee after say some years becomes 40. So your margins today may be 30-40%, but they may go down to say just 10 or 12, or you may end up in a loss scenario. So whether in your contracts you have defined who has the foreign currency risk, whether it is with India or whether it is overseas, whether overseas is going to insulate you, and to what extent the tax authority respect those agreements is another question. Product liability risk, like if you are a distributor and somebody has manufactured those products, whether that risk is with you or whether you can, because ideally if a product is manufactured by a manufacturing entity, as a distributor, if you are taking a hit, the officers may have a problem, because if it is a manufactured item and if there's some manufacturing defect, it has to go back to the manufacturer. So whether your methodology is in line with the substance, that is also how your risk has to fall with it. The R&D risk, the credit risk, foreign exchange, these are some of the risks that we come across. Similarly, you may have a cost overrun risk, where an Indian entity is buying some components and has some projects in India, but it may be into losses continuously. So whether there's a cost overrun risk, because your project may have, you may have won that project 2-3 years back, but by now it may happen that all the raw materials, like maybe the cement, the sand, all those prices have appreciated and you hadn't estimated those, or maybe your escalation clause was not good enough to cover those. So whether you are able to document that risk is another important thing, because increasingly it's not necessary that transfer pricing is the reason for your losses. So all these cost overrun or maybe idle capacity, and in fact tribunals allow idle capacity adjustment. So whether these risks are with you, identifying that is very important. I have another 10 minutes. So what is the outcome of a functional analysis? So in a functional analysis, it may happen that you are an Indian entity is a service provider, or maybe it's a entrepreneur. So functional analysis helps you to know that. In a distributor also, you could have various models. Like some companies say that we don't want our overseas entity to take the inventory risk. The products will be directly shipped from my factory to the overseas customer. He will just be doing that coordination, taking title, because the overseas customer wants. So in that scenario, whether you want to give him a return which is equivalent to a full-fledged distributor, maybe no. So maybe he's a limited risk distributor. So that all you will come to know from the functional analysis, whether it's a commission agent, whether he's a contract manufacturer, toll manufacturer, full-fledged manufacturer. So companies have different type of models, and their agreements, their documentation needs to be in line with all those aspects. So this is an interesting case study, and we can probably deliberate on this case study, where India is a subsidiary of an overseas group, and this Indian entity is manufacturing certain components which again go to the UK, and UK may be selling this to the third party. They also procure these components from UK, also procures these components from third parties. So this is a scenario one where India is selling the product to UK as well as to third parties in India. So in this kind of a scenario, what is going to be critical is that India has its own business, which means it is dealing with a third party. So India, maybe from the functional analysis you'll realize that it's not a contract manufacturer. It may happen that 40% of your business is with UK, 60% is with a third party. So you may be like a normal manufacturer who has your own plans for the domestic business. You may have your own marketing budgets, etc. So you are also selling to a third party. So whether a cup is possible, UK is also procuring those products from a third party. So whether cup is possible from those perspective. So when you do functional analysis here, your functional documentation should be clear, the functions, assets and risk. Like India is taking the market risk because they have their own independent business. So whether India is a contract manufacturer, full-fledged entity. So from those functions, asset, risk, the officer should be able to know that okay, India is a normal manufacturer. Apart from that, you will also have to interview the UK team to understand what are the components they are procuring from these third-party manufacturers, whether these components are custom made components, because then maybe even the cup in India fails and overseas fails, or are these components standardized and one-to-one comparison can be done. So you can do the India comparison, whether I can also use the overseas data for comparison. And when you're using overseas data, here you will face a challenge, because that data from the overseas, when you're using for cup, the officer would want to know whether you've just chosen certain invoices which are favoring you, or whether you have covered the entire sample. So if suppose, let us assume in India you don't have a cup, but the overseas entity has shared some invoices with you, and then there you use a cup, there you will face a lot of problem in assessment, because the officer, in the first place, it's an overseas data. To what extent is it accurate, whether you have just chosen certain invoices? So you may also be prepared to face questions such as whether you have covered the entire population, how should I tie up, whether this is audited, can you get this audited or certified from a third party consultant. So these are questions that you may come across, or he may outrightly even reject that data, saying that, okay, how do I know that the quality is same? And with all these components, even for, it is only the technical team who will exactly know whether the components are same. So whether your invoices accurately capture the description of those components, in which way can you prove? So when you use Indian comparables, your efforts are much simpler, because all the data is readily available. But when you use overseas, you have to be cautious, especially in a cup scenario, to ensure that the data that is being given to you is authentic, and how will you reply to certain questions about the products. Those are certain challenges you may face. Now, this was the characterization in the scenario 1, where both India, UK were normal risk manufacturers. India can be tested party. In this scenario, you have cup, you can use that data. Now we have slightly twisted the fact, and we are now saying that India is only manufacturing and selling for overseas. Now here there are various models which are possible. It may happen that the overseas may say that I will put India on a cost plus entity, make him a contract manufacturer, insulate him from all the risk. Or it may happen that the group also says that if I do this, the Indian entity becomes inefficient. There may be so many costs that come up, and I don't have control over those costs. I want Indian management to be held responsible. So they may have some per rate pricing with you. So that means they have shifted some amount of market risk, the foreign exchange risk, capacity, whether they have shifted capacity risk to you in that case, because it may happen that the products are seasonal, and when there's no demand, you also are impacted, and because you don't have the right to sell to a third party, you have to undertake those risks. So to what extent the officer will be willing to accept your methodology, or whether he'll be tempted to characterize you as a contract manufacturer. So in these scenarios, these are the kind of questions that you may come up. So the agreement is very critical, whether in the agreement he's given you certain rights, or whether your rights have been curtailed. So if your rights have been curtailed, the officer may be right in questioning how the market risk or capacity risk is put to you. So increasingly, there are so many questions that you will face, that as transfer pricing matures, that apart from just benchmarking, the other documentation also becomes critical. So in these scenarios, so say India is in a loss scenario for 2-3 years, but in the 4th year it has become profitable. You are able to demonstrate to him what were the reason for the losses, what were the inefficiencies. Maybe you were doing trial production, your batches of product were not up to the quality mark and they were being rejected. Whether upfront that risk was with you, whether you were told upfront that okay, you are going to be responsible for the rejects, because the quality standards are of theirs. So whether there was some problem with the quality standard, or whether the problem was in the Indian setup. So these are all smaller and finer things which will come out in a functional analysis, and which have to be documented for litigation ease. So I think we'll stop at case study 1, because case study 2 is quite simple. It is about a service. I can take 10 minutes more. So in a service scenario, again, this was like in a manufacturing setup. As I said, the functional analysis is complicated because there are so many finer things that come about. But in a software setup also, things are more or less known. Okay, he's a software service provider, but within that also, as I said, whether within software also he may be into a specialized software, like he may be just doing GIS, or whether his is an ERP and he's just implementing it. And how niche is that software product, whether I have lots of competition and this is how competition is operating, and even we want to operate on a similar fashion. Like for example, India may be a distributor, so typically in software industry it may happen that my competitors are charging a royalty rate of, say, let us assume 30 to 40%, and I have that information. So I am able to back that up even with my royalty databases. So whether I can use this data to fix my methodology with my Indian company, or whether, because it may happen that tomorrow suddenly India becomes highly profitable. So what is my product and what is its potential? So when it becomes profitable, 50%, 60% of the profits will continue to remain in India because I'm charging him 40% royalty. So whether you as a businessman are open to that. So if on day one you take a call that, okay, the product is such that I am willing to leave behind 60% profits in India. 4-5 years down the line when India becomes profitable, whether you're changing the model and then saying, no, let me make India a limited risk distributor, keep only 3-4% margins and take the entire thing as royalty. So what you've done is you've restructured your business in India. He was a full-fledged distributor, you have converted him into a limited risk distributor. And as you see, the definition of international transaction has been changed, where the last clause is business restructuring, whether it has impact on your profits or not. So these transactions also you will report in your form 3CB, and there if they see that initially your model was this, but now you have made him into a limited risk, though you may leave behind a 4% profit, which is comparable with a distributors, he may still come and challenge you, and he may still come and make adjustments, because that's how the law is now. So these are some of the precautions that you need to take. So though you may have the right functional analysis and the right benchmarking, it also needs to be in substance, and whether that continuity is there is the other question that you need to have answer to. So with that, we complete the session on functional analysis, and if you have any questions, let me know. See, forex loss, we have seen various methodologies, and whatever methodology you use, you have to stick to it. Ideally, if he's a captive service provider, in any scenario, a captive service provider will never have the right to, take up that foreign exchange risk, because he is working with you, you are paying him in US dollars, and if he's captive and if he's a captive, to what extent you want to insulate him from that risk? Because it may happen that if he's going to be a cost plus entity, cost plus 15%, and if there's a huge foreign exchange loss, how is he going to be able to mitigate that loss? Whether he has the necessary capital in place, if there's so much of loss, the Indian entity can upfront face that loss, or whether he has the necessary people who know how this has to be hedged and how I'm going to try to reduce those losses. So if, let us assume the Indian company has the necessary capital or credibility, then they may want to keep that risk in India. But at times we also see that they define the foreign exchange rate upfront, that okay, this is the rate, we don't want the risk to remain in India, but we want to take the risk upon ourselves. So typically, more and more we have seen agreements where the foreign exchange risk is not with the India but the overseas entity.
So even markup will be paid on?
Yes. So similarly, when there's a gain, they may even reduce that. But so there's no harm in the risk being with India or with the overseas, but whatever you're doing, you need to be done, you need to have a symmetry. If you read all the literature on foreign exchange, what they harp on is the symmetry, which means in the first place, whether Indian entity can mitigate and take up that risk. If it is a captive, it may happen that maybe it does not have adequate capital. If there's a 5 crore loss, whether they have that much capital to take that risk. If no, then that risk has to be overseas. And whatever model you're doing, follow it with consistency. So if the risk is, say, with the Indian entity, and tomorrow if there's a foreign exchange gain which you want to take overseas, again there's asymmetry in that which will not be accepted. So there are various ways in which this can be done. So thanks a lot.
That Vaishali in her lucid presentation made us look far very near. And before I request Praveen Bhai to propose a well-deserved vote of thanks, let me share a few things more about Vaishali. Vaishali is always available to the chamber in whatever activities we want. And recently we have launched a study circle specially on transfer pricing. So it's right from conceptualization to organization, she is involved and committed to that. We always thank you for that, Vaishali. Thank you. Praveen Bhai.
Friends, at this juncture, I am reminded of a small story. As to a friend of mine was telling me all the while, as to I have always a quarrel with my wife and I have the last word. And I asked him as to what is that last word. He said, sorry. Here is a case that I have a last word for this morning session, and that is thank you, Vaishali. Friends, you will agree with me that she has dealt with the subject in a very detailed manner and very practical way. And secondly, she has made us, emphatically brought out a point that TP is a more database or fact-based case, and therefore our data or documentation must be very strong. In that case, certainly, even leave a law aside, definitely our lawyers will take care, but as far as the database concerned and documentation is concerned, we will certainly get the case in our favor. And thirdly, that she has, you will all agree with me, that now we are better equipped to deal with our TP cases in a better way. Friends, please join me to applaud her.
We break for lunch and we reassemble at 2:15. Thank you.